So, colleagues, shall we begin? Welcome to the first lesson. Look, the first lesson is the foundation of all foundations. This is a very important factor. By the way, in this course, I won't be telling you what candlesticks are or what a trend line is, because this course is intended more for those who already have some basic knowledge. If you don't have a basic foundation, you might as well not watch this course. First, you need to watch a course about what candlesticks are, what markets are in general, and well, you need to get a bit familiar with the absolute basics, the fundamentals. Now, look closely, because every single instrument, without exception, possesses its own unique and rich history. Before you even consider beginning to work with any particular instrument, it is absolutely essential that you thoroughly understand and know it intimately, truly by heart, comprehending its origins, evolution, and fundamental characteristics. In other words, you can't just open, for example, TradingView, right? And then start looking for a position here, go through all sorts of cryptocurrencies, then move on to gold, then to silver, and then to some index. No, it doesn't work like that. Of course, maybe it works that way for traders who have such a system. In my case, I will be telling you about my own system, the one I personally use on my trading accounts, on our investors' trading accounts, and also the one we used back when we worked at a hedge fund. And to work calmly and consistently, for me personally, it's entirely enough to have just one or two primary assets, and you'll always have your hands completely full. In this comprehensive course, I will clearly show you how you can work comfortably and effectively with just one or two key assets, and you'll always be fully engaged and productively occupied. Many people think that you need to work with a dozen different assets, looking for certain levels or moments to enter on a breakout or not. Yes and no. It really depends on your strategy. Of course, if you use a level-based strategy, for example, on the daily or hourly time frame, and you're not interested in the asset itself at all, okay, so that approach has its place. Unfortunately, I don't specialize in that concept. I know there's another trader who does this, and he's quite well known. So I checked out his course, everything's really cool, everything is fine. But of course, you need to adapt this strategy to suit yourself, right? That's why understanding these things is so important. So let's get back to our topic. We will be working with one, at most two assets at the same time. Why? Because we'll have a clear understanding of what this asset does, what its potential movement is, what its volatility is, and what can happen on the 15-minute time frame, the 1-minute time frame, the 10-minute time frame, the 4-hour time frame, and the daily time frame. We'll know it inside out. In order to know an asset inside out, you need to do an analysis. What is analysis? We need to know several important indicators. The indicators we need to know will be your homework. That's why we'll use gold as our base, because we'll mainly be working with gold. Of course, you can also analyze Bitcoin, silver, some euro, dollar, and so on. I'll start with gold, because that's really my area of expertise. I've been working with gold for quite a long time now. All our results are public, you can check them out. All the links are provided below this video. So look, your task will be to understand how much of an impulse gold makes. So yes, there's the Dow Jones theory. I'll get to the impulse in a moment. What does the Dow Jones theory mean? An asset moves in impulses. It has an accumulation zone or a distribution zone. Then there's an impulse, then again an accumulation zone, a correction, or another impulse, then a breakout and upward movement. So we need to understand whether in percentage terms, in pips, in dollars, it doesn't matter, I'll speak in percentages because that's what I'm used to. What is the potential movement range of this asset, right, on different time frames? Why? Because we understand when an asset is in some of its local zones, that is historically, for example, I know that if on the 15-minute time frame, gold makes an impulse move greater than, say, 2%, let's say, drops by 2% in just 2 or 3 candles. I know for sure, 100%, without any oscillators or indicators, that there will be a pullback here. The question is, it might drop by 2%, it might drop by 3%, 4, or even 6%. The maximum drawdown on the 15-minute time frame for gold, let's say with candles like these, without a correction, without a pullback, was 6%. That's the largest historical move. But even at the 2% level, that's already the average movement for this asset. So when the asset drops by 2% on the 15-minute time frame, I can easily go long here absolutely calmly and catch the pullback. And this pullback is nothing other than, as per Dow Jones theory, which says that any asset, after rising, makes a correction of about 30% of its movement, or when it falls, makes a pullback to the level of about 30% of its decline. This can also be measured using Fibonacci. For example, we find where the impulse started up to the point where the impulse ended, and any asset, always, I will show you this now, makes a pullback, always. And at the 0.38 level, for example, if I enter here, our task will be to understand when to go long after such a drop or when to go short after a pullback. We will study all of this, but the 0.38 level, yes, that's about 38% of this move. It always makes a pullback. Look, I'm switching to the 15-minute time frame. Let's take the latest asset, that is the latest trend gold. Here's the impulse. And you need to do this as homework. I'll explain how in a moment. Here's the impulse. See, here is the impulse now. Here's the pullback. Here's the impulse. Here's the pullback with the trend reversal. Next, here's this downward impulse. Here's this upward impulse. Here's the impulse. Here's the pullback. Here's another impulse. Trend reversal. Again, we observe the impulse. And again, we see the impulse. The impulse, the impulse, the impulse. You see, after every impulse, there is even a pullback. After every strong downward impulse, you see, even here, it might seem like a small impulse, but in fact, here's the pullback. All of this is the Dow Jones theory. So, in order to understand whether a corrective phase actually occurred here, or if the market skipped the correction, I take the Fibonacci tool and stretch it from the bottom to the very top. If the asset drops to the 0.38 level, for me, that's a corrective phase. That means, with a high probability, it will continue to go up, and it can keep rising indefinitely. In other words, it has completed its correction. Next, we have an impulse. For example, the next one you see, here and here, a correction occurred down to the 0.61 level. Everything that happens down to the 0.61 level, for example, in this case, is considered a corrective phase. If the market drops below the 0.61 level and consolidates there, then with high probability, it will change its trend. That's why the 0.61 level is so important. If the market loses the 0.61 level, that is the asset's value, then it will most likely continue to go down. Again, we are working with probabilities. There is no 100% certainty that the market will behave this way. That's it. You just need to be aware of this. So our task after, for example, another strong move, I'll show you here. You see, we have 1.40%. That's quite enough for gold to start looking for a short entry here. That is starting from about 1.2, 1.3 and above. This entire upper area, regardless of where it goes, is a zone for entering short positions. I'll explain to you later how this works. Right now, you just need to understand this structure. Next, we also have, again, we use Fibonacci. We see that here we have an impulse, a corrective phase, then the next impulse sent, I want to pause here. You see, this is an impulse. There is a particular situation where the asset can completely skip this corrective phase, specifically when it bypasses this initial impulse. But in this precise moment, we are truly on the very edge of that happening. So why is that? Because the asset did correct itself, but it literally just fell short of reaching the 0.38 level. Usually when I place orders to buy, sell, or close a position, if, for example, I open the short here, I always try to exit before the 0.38 level. That is, I set my closing order just a bit above this level. If I shorted the asset here, why is that? Because it will definitely retrace, but it's not guaranteed to actually touch that line. After such an impulse, the probability of a retracement to the 0.38 level is 99%. But there's still that small chance that it won't quite reach it. This happens from time to time, and it can vary from broker to broker. Maybe with one broker it reaches the level, but with another it doesn't. That's why I always set it just a little bit higher for my own peace of mind. There you go. Then a new impulse occurs. Here it is, right here. You see, it came back to the 0.38 level, even touched the 0.5 level and bounced off from there. The same applies to longs. If the market is strong, then after a strong impulse, like after a sharp drop, for example, here you see it came back again to the 0.61 level and tested it. So what do we know now? In fact, we are generally in an upward trend on the higher time frame, but on the short time frame, like the 15-minute chart, we are in this situation. What does this mean? It means that if there is a breakout, today is Sunday at the time of recording this video. What date is it today? June 15th. When we break above this level, we will most likely set a new high. However, if we were to experience a significant drop below this particular level, it is highly probable that we could indeed return and effectively reverse the current prevailing trend, moving towards the next, let's say, some truly important zone. And in that specific scenario, this would be nothing more than just a temporary pullback, a minor correction in the overall market movement. That would also be considered a pullback. There you go. Now, what do you need to do? Homework, take a pen and paper, and you basically need to figure out which time frame you will be working with. Personally, I'm comfortable working on all time frames, but it depends on your schedule. Of course, if you have a job and don't have much time, then naturally the 4-hour time frame will be more interesting for you, 4 hours. But with the 4-hour time frame, you need to understand that your positions might be held for a longer period, whether you use a stop loss or not. Because I will show you strategies both with stop loss, with hedging, and without stop losses. Accordingly, you'll be able to choose what's most convenient for you. So when you work with the 4-hour time frame, you understand that your position in principle will be closed within 1 to 3 days. Maybe even 4 days. But if it gets stuck, it can remain open for about a week, right? Up to 10 days, let's say. Up to 10 days. If you work with a 15-minute time frame, your position is generally closed within the same day. That is right away, well, by the next day at the latest. Rarely, very rarely, it might carry over to the second or third day. And if the position gets stuck, it might stay open for 1 or 2 days, 2 days. So that can happen. Why? Because with a small time frame, the cycles are faster. If you work with a daily time frame, your positions might stay open for weeks, even months. So you choose the trading format yourself, but we'll come back to this later. Now, for your homework, you take an asset. Let's do all of this with gold. Because if you understand how gold works, the same principles will apply to other instruments. This is just for my convenience, so I don't have to repeat myself later. You take 15 minutes. During these 15 minutes, you divide a sheet of paper into 2 parts. Choose a side, long or short. You need to calculate, as I showed you, the maximum possible period that TradingView or MT5 allows you. Take the maximum, the absolute maximum it gives you, and calculate it. It doesn't give us that much, you see. Here I have the paid version. Maybe you'll have even less. Alright. What do we have here? November. Well, at least take a year, okay? For example, you go here, and you need, for instance, let's take it from this point, just setting it for simplicity. So from this point, the more you take, the better. I already have these parameters in my head. It's important that you do this yourself, because if you do it yourself, you'll understand the asset perfectly. And it's not hard for me to give them to you. Look, 15 minutes, here it is, the impulse. You can clearly see, even with the naked eye, that an impulse is happening right here. It started here, and bam, up to this level. Here's the impulse, here's the pullback, and here it continues moving further. Then again, a pullback, another small move, another pullback, another small move, another pullback. Now the story changes here. Then comes another impulse, here's a big impulse, and here's the pullback. So let's go back. You need to measure what percentage of the move it made here, 1.16. See, we have 1.16, and after that, an impulse occurs. Where I was writing with a pen on paper on the 15-minute chart, you write it down. So for example, we were in a short position, that is in the short zone, and on the 15-minute chart, it made 1.16% here. Then we have another impulse upward. Look, here you can see by the Fibonacci dot, you see by Fibonacci an impulse is considered to have occurred when it returns to the 0.38 level. I'm not interested in what happens next, whether it goes down or up. I just need to understand. Pullback, impulse, that is impulse pullback. That's it. There it is. Super. And now we look for another impulse. Here we can see that one has formed here as well. This is also an impulse. See, it just bam, it reached from this level to that level. That's the impulse. See, pullback to the 0.5 level. Yes, it's enough for us if it reaches the 0.38 level. What percentage of movement is there? We are watching 0.67. Okay, we write 0.67 here. So we have a long position here, right? Here we have a long. The value is exactly 0.67. Okay, let's look for here it is. The new one, here it is, the movement. You see this part, this is also an impulse. Let's look. It reached the level of 0.38. Yes, it reached the level, so everything is okay. Let's calculate what's the percentage here. 0.51. Yes, that's important. All impulses that are less than, say, 0.40, we just don't count them. Why? Because they're too small. We're not interested in them. Even 0.5, let's say 0.5, because 0.5 is already on the edge. Let's write it down. I deleted it. No big deal. So here we had a short 1 minus 1.1, something like that, minus 1.5. I don't remember, maybe 6. Here we had 0, I don't remember, 6. And here we have 0.5, 0.5. Let's move on. We're looking for impulses. When we have these sideways moments, of course, if you don't understand, try compressing the chart like this, and it'll get a bit easier for you. Next, we see that a new impulse is happening here. Here it is, as you can see here, right? Here it is, the impulse. Yes, there were some small consolidations, but we're not interested in those. What we're interested in is this impulse. And here is the pullback. Here is the next impulse. Here is the pullback. Here is another one. And here is the pullback. Here too, you draw the Fibonacci. Well, I can see with the naked eye that here we had 0.6, 0.6 for a short. I write 0.6 here, 0.6, and I'm doing all this on the 15-minute chart. That is 15 minutes. Then when you have, I don't know, perhaps 200 or even 300 or possibly 400 of these individual positions meticulously recorded here, when you carefully count every single impulse, you will absolutely need to take all of these accumulated positions and precisely calculate their accurate ever, performing a thorough statistical analysis of the data. So you need to add the first gain, the second gain, the third gain, the fourth gain, the fifth gain, the sixth gain, the seventh gain on a calculator, right? And then divide by the number of these impulses. So 1, 2, 3, 4, 5, 6, 7. Let's say you end up with about, I don't know, 7% movement here, just as an example. You take this 7% of movement and divide them by these 7 positions. Well, whatever you get, right? As a direct and observable result, you will begin to fully understand that the average movement on a relatively short downward trend is approximately 1%, for example, in the typical market scenario. That's not true. I'm just making this up right now. You need to find your own parameter, say 1%. So you know that the average movement of the asset on the 15-minute time frame is 1%. And after that, there's always a pullback. Also on this list, you'll have the maximum value. So you write down all these things, then stick them somewhere you'll need them next to your computer. The maximum, I don't know, maybe it'll be 6% for you. The minimum, well, the minimum doesn't really matter to us, but that's okay. The minimum might be, say, 0.4, right? Because we won't go even below 0.5. We won't take anything less than 0.5 into account at all. What does this mean? And it's the same with long positions. So the first, second, plus third, plus fourth, fifth, right? You divide by the total number. For example, for longs, you might get something like 1.3 as the average movement. The maximum movement you might have, I don't know, say 7%, and you'll know that this asset, gold, for example, on the 15-minute time frame can give a maximum impulse of 7%, while the average impulse of all these movements is 1.3%. This is very important. You might not fully understand this right now, but you will later when we go through all this practice together. And why is this necessary? Because when you have this kind of statistics, for example, on the 15-minute time frame, and then you do the same thing on the 4-hour chart, right? When you have this kind of statistics, it might happen that someone wakes you up at 3 in the morning and says, guys, I don't know, Vanya, gold just dropped 2% in 2 15-minute candles. Even half asleep, without understanding, without looking at any levels, any indicators, any oscillators, you'll just say, open a long position further. What kind of long position should you open? That will be the topic of our next lesson. Because next we need to talk about money management. because without money management, all of this can just be thrown in the trash. But for now, basically, you absolutely need to thoroughly learn this particular movement, and you can certainly do precisely the same thing, for example, on the 4-hour chart, which is a common time frame for analysis. Take the maximum available history that the chart gives you and check it. So on the 15-minute chart, this work will take you about 3 to 4 hours. Basically, you just sit down at the computer and work for 3 hours, and you get some statistics. Write down these statistics, do the same thing on the 4-hour chart, and you'll get statistics there as well. Of course, on the 4-hour chart, the results will be different. Why is this necessary? This is necessary because you will know what is happening with the asset, what its average and maximum values are. You won't be scared, you won't get lost. Based on this statistical data, you'll build your own strategy, and you won't care whether the asset is going up, down, forward, or back. In other words, you'll already know what the range of movement is, how things are here, how things are there. Then, once you have this data, you add levels, indicators, oscillators, and other parameters. This is absolutely required for the next lesson. If you don't do this, don't watch the next lesson. There's no point. First, complete this step. I know I'm giving you this lesson for free, but believe me, people, myself included, have paid a lot for this information at one time. This is basic information that many people skip, but the whole secret lies in the basics, in simplicity. That's all. I hope I haven't tired you out too much. Do this on the 15-minute, 4-hour, and daily charts, definitely on the daily chart. Then write to us in the comments, and I'll reply, I'll tell you whether it's correct or not. Or write to us on Telegram. By the way, support our project with a like, support our project with a comment. This is very important for us because, let me remind you, we don't make money from advertising, we don't make money from referrals, we earn by selling trading algorithms. It's very important for us that a lot of people watch this video, because in the future, the algorithm that we will be sharing with you verbally, we will also be offering and selling. Our business model is as transparent as possible. That's all, guys. Peace to everyone. Goodbye.